Good day, everyone. So, this is a Forex guide for beginner part one for beginner trader. So, we are going to be talking about the pair, how to make use of trading view, and how to be able to read the Forex pair. We have the Forex pair, we have synthetic. You can get the synthetic in the reef. And we also have some indices where we have the US 30. For example, we have the stock market. The stock market where you have the Tesla, the Nvidia, and Apple, and so on. You can invest in this stock market as an investor. So this is the future. You can decide to also invest in all this future, make your analysis. You can see this analysis is going up. So there is a way you make your technical analysis on this future. Then you are going to embark on those projects. And we also have the forex, which is the most common part of trading. So this is the forex pair. Pair means two currency. That's why we call it forex pair. So we have many current forex pair, and you can decide to choose one. You can see in this case we have in this trading view we have Euro USD. We have more than three brokers. See this tick mill, this one up here, tick mill, FXCM, Wanda, FXCM, Forex.com. All these are brokers. So I can click on all resources and click on one of those brokers. But I prefer using the Forex.com. You can see the Forex.com bring out every pair. Now let's talk about this Forex pair. So you can see the first one is Euro USD, which is the Euro slash US dollar. It says that the Euro is a base pair, while the USD, which is the United States dollar, is the counter pair, which means that when you are buying Euro, you are going to be selling US dollar. And when you are selling Euro, then you are going to be what? You are going to be buying US dollar. It is why we call it a forex pair. When you are selling one, it means you are buying one. When you are buying one, it means you are what? You are selling one. For instance, now if I should buy this pair, Euro USD, it means that what? I'm buying US and Euro currency and I'm selling USD dollar. So is that clear? So we also have some other forex pair. We have GBP USD, which is the British pound against the US dollar. The GBP is the base pair, and the USD is what? It is the counter pair. We have the USD JPY, the US dollar against the Japanese yen, so the Japan currency. The USD is the what? Is the base pair, while the JPY is what? Is a counter pair. We have GBP JPY, that's the British pound against the Japanese yen. The GBP here is what? Is the base pair, and the Japanese yen is the counter pair. AED USD, Australian dollar against United States dollar. So the Australian dollar is the what? Is the base pair, while the United States dollar is what? Is the counter pair. So we have a lot of pair. We call them the forex pair. These are the forex pair. You can see we have so many forex pair. You can decide to embark on one. You can decide to embark on 10. You can decide to embark on 15, as long as you follow your strategy. But I myself, I trade all pair. I trade of both major pair and the minor pair. So we have the major pair and we have the minor pair. So the major pair are the one that have high volume. That when you trade them, it is very easier for you to be able to make your money faster. It is easier to make more money faster on the major pair compared to what, to the minor pair. Now for the major pair, they are the one that has United States dollar as what, as a pair attached to them, as a currency attached to them. For example, the Euro USD is a major pair because the United States dollar is attached. The GBP USD is a major pair. The USD JPY is a major pair. AUD USD is a major pair. USD CAD is a major pair. USD CHF is a major pair. NZD USD is a major pair. You can see the one that has United States dollar is a major pair. Now the one we have GBP JPY is not a major pair, it is a minor pair, but it is very volatile, very volatile. When you trade this, in fact, the GBP JPY is more volatile than all those major pair. So it is the GBP JPY that has the that it is the most volatile pair in all these forex pair. Exactly. So the Euro JPY doesn't have the United States dollar with it. This Euro JPY. So it is what? It is a minor pair. The Euro GBP, that's Euro against British Pound, it is a minor pair. GBP card is a minor pair. AED JPY is a minor pair. AED card is a minor pair, and so on and so. Card JPY is a minor pair. GBP NZD is a minor pair. NZD card, they are minor pair. AED CHF and so on and so forth. Because it doesn't have the United States dollar. So I think the major pair we have is Euro USD, which is 1, GBP USD, which is 2, United States dollar JPY, that is 3, AED USD, that is 4, USD card, that is 5, USD CHF, that is 6, NZD USD, that is 7. So I think we have 7 major pair and so on. That is for forex pair. So we also have the next one, which is the cryptocurrency. Can decided to trade BTC USD. We have Ethereum, that's Ethereum against United States dollar, that's Euro USD. You can see we have a lot of brokers here that also participate. So you can decide to choose one. So I make use of Bitstamp, or I make use of Binance or Coinbase. So let me choose one. So Binance, I can decide to use Binance. You see the BTC USD. I can say to trade ETH USD, Solana USD, and so on. All these are called the crypto pair. Now these indices, now you can see we have the XY if you are trading United States dollar index. So the currency index, the DXY, you can decide to trade it. And we also have US 100, you can also decide to trade it. We have the NASDAQ, which is the United States company, all those manufacturing company. You can decide to trade NASDAQ. US 30 also, you can decide to trade it. So all these are called index. We also have another one that we call the Meta. That is gold. If you want to trade a gold, you can see this is gold. This is gold. This is XAU USD. That is gold against the United States dollar. So all these are the forex, are the trading pair that we trade. So, but most importantly, the forex pair is the most popular pair traded after the gold. Gold is the most traded pair. Not gold is not a forex pair, but it is a meta and it's also a pair. So after the gold, the most traded pairs are all these forex pair. So now let's still go to the basic of forex. The basic of forex. You are going to be talking about the the beginner trader. So how to go start, how to be able to know the direction of of our market. So let me make use of one pair as an example. So we I've explained about the pair that we have in Forex, and I've also explained the indices and the, the metals and the cryptocurrency pair. So I'm very sure we are aware of that. So we have three types of market movement. Three types of market movement. You have to know this that we have types of market movement. Types of market movement. So number one, we have what we call the trending market. Trending market. Number two, we have what we call the ranging market. The ranging market. Number three, we have what we call the shopping market. Shopping market. The shopping market. Now for the trending market is divided into two parts. The trending market is divided into number one, the uptrend market. The uptrend market and the downtrend market. The uptrends and the downtrend market. So these are the two types of trending market we have. So the three types of the market movement we have the trending market, we have the shopping market, and we have the ranging market. Now you have to take note that the shopping market avoid this type of trade at all means. Avoid at all means. Avoid this type of trade, take shopping market at all means. Now let's draw this type of market that we had. Then from there we move to the chart to look on all these types of market movement. Now number one is the trending market. And I said, if you remember, I said the trending market, we have the uptrend and we have the downtrend. And you have to know that market will never move in a straight line. Market doesn't move in a straight line. Market move in a way that it will go to a direction, it will retrace, it will correct and go back, it will retrace, correct, and go back to the actual direction. You need to know that. Market doesn't move in a straight line. You need to know that. Now let's talk about the types of market now. Number one, which is the what? The trending market. We have two types of trending market. We have number one, we have the uptrend. You can see the uptrend. Market will go up, come down a bit. This is what we call retracement. Then go to the actual point, actual direction. This is correction. Then move, come down again. Then go up. It will come down, goes up, come down, goes up. Now you can see this is an uptrend market. This is one type of what? Of trending market. This one is called an uptrend market. An uptrend market is a market where we have the higher lows and the lower lows. You can see this point. This point here is called the higher high of the market. This first arrow is called the higher high of the market. This is the higher high. We call this higher, higher high. You can see this is the higher high. can see this is higher high and this is the higher lows. This is the higher lows. Higher lows. You can see the market in an uptrend will be forming the higher highs and the higher lows. Now this one is higher high, higher high, and this one is going to be our higher lows. Sorry, this is going to be our higher lows. And so on and so forth. You can see the market, when the market is forming the higher high, higher lows, the higher high, higher lows, the higher high, higher lows, then that market is in what? Is in an uptrend. It's higher highs, the higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows. So when market is forming this kind of movement, then you are what? Finding a buy opportunities. Uptrend is a buy opportunity. It means that this uptrend market is in what? In a bull run. You can call it a bull run. It is in a bull run. That is bull run. On the market is what? Is what? In a bullish direction. Is bullish. It's bullish. The market is what? Is in a bull run, or you can actually say the market is bullish. So, and when market is moving up, we call it a bullish market. And when it is coming down, we call it what? A bearish market. Now, this is an uptrend market where the market is forming higher highs and higher lows. Higher highs, higher lows, higher highs, and higher lows. Now, let's really go to the second type of trending market, which is the downtrend market. The downtrend market will come here from something like this. You can see so the market will form this way in a downtrend market, and the downtrend market is called a bearish. It's called bearish. This is a downtrend market. Downtrend, and it is in a what? A bear run, or you can call it the market is what? Is bearish. The market is bearish. Now, note that in an uptrend market, the markets will form the higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. But in a downtrend market, the market will form what we know as the higher low and lower. Sorry, it's going to form the lower high. The market will be forming lower high and a lower low in a downtrend market. You can see lower low. You can see what the downtrend market is forming. Form a lower high and a lower low. You can see what the market is forming. It means that when the market is giving you this type of scenario, then the market is what? Is in a downtrend market. It's forming the lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So this is what? A bearish market. Now you need to know that the lower higher high and higher low for you to know that there is still a continuation of this bull run or uptrend market, it means that this market, once the market retreats down here, it means that for this continuation of this bullish, it must break this higher high up. It must break the structure of this higher high. It must break it up for you to what? To know that, okay, this particular market is still going to go up. And we call this breaking of higher high, we call it a break of structure. You can see this is a structure. Higher high and higher low is one structure. This is one structure on its own. You understand? This is another structures on its own. This is another structure of uptrend market. These another structures of uptrend market. Now, when this particular market retrace back and break this higher high, the highest high of this market, then it is still in a what? In a bullish market. Now you can see the market break this particular higher again, and we have what we call a break of structure. BOS, that's break of structure. You can see this higher high was broken again, then the market keep going up. And this higher high was also broken, and this market keeps going up. Is that clear? Now look at this downtrend market. Downtrend market, the lower low will keep breaking. The market will keep breaking this lower low. The lower low means the lowest low for it to move down. While the higher high means it needs to break the highest point for it to keep going up. You can see the break of structure happens in this case. It break this lower low. This is where you know that okay, this market is also still going down. You can see keep going down. You can see. So this is the trending market. It means the market is either moving in a bullish market or bull run, or the market is in a bearish market. Now let's talk about the second types of market movement. The second types of market movement. Second types of market movement. This is the first. This is the trending market, uptrend and the downtrend. Now let's talk about the ranging market. The ranging market is going to move. It's going to have what we call the range. It's going to have the upper range, and it's also going to have the lower range. It's going to have the upper range, and it's also going to have the lower range. Now, this market, when you see a market moving in this way, it's going to be bouncing back on those range. It's going to be bouncing on those range. You can see the market is bouncing on those range. You can see the market is bouncing on those range. So when you see a market in this way, it is what? A ranging market. This is a ranging market. So you can trade either a trending market or a ranging market. So the third types of movement we have is the shopping market. The shopping market. Shopping market. The shopping market has to be avoided at all costs. You must run away from what a shopping market, because for a shopping market doesn't have a clear direction. You need to move haphazardly without a clear direction. You see, when you try to enter this type of trade, you will lose all your money because it is not advisable to trade this type of market. You can see it doesn't have a clear direction. So you avoid this type of market at all costs. Now, the video I want to be making is 30 minutes. So I'm going to make another video where we are going to spot this type of market movement on a real chart. So, but before we go, I'm going to show you, explain again. We have three types of market movement. We have the trending market, we have the ranging market, and we have the choppy market. For the trending market, we have the uptrends and we also have the downtrend. Now for the uptrend, you are going to be having the higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. To confirm if there is still a continuation of the uptrend market, means that the market after the retracement needs what keep breaking the highest high of the market. Now this part, this one that is retracing is called the retracement. This is called the retracement. This point is called a retracement. Retracement. It is called a retracement. Why this point that is correcting back to the uh to the position, to the normal position, correcting back. It's correcting this market back to the actual position. It's called the correction. You can see. Is that clear? So for the downtrend market, this is going to be our correction because it is correcting it back to this normal direction. This is called a correction. Why this one is called a retracement. This one that is retracing to the opposite direction. I've told you the market will not move in a straight line. This is called a correction. You can see. So for this trading market, we always have a retracement and a correction. Now let's look on this ranging market. Ranging market is not retracing; it is moving up, moving down of a band. Do you understand? It is moving up and moving down on a band. While the shopping market should be avoided at all costs. So in the next video, we are going to be talking about the support and resistance of this particular trade, of this particular market movement. So all these are called the market structure. You can either call it market movement or market structure. Since me I dey join rice before, e get one time ago more repete. I don't want